Hello, Adrian. Despite all the talk about American exceptionalism, year-to-date, the S&P 500 is down, and the MSCI EFA is up 8%. Can you comment on what's happening between U.S. and non-U.S. markets? And specifically, are geopolitical developments, like the German election or the Ukraine war, having an outsized impact?
Great question, Andrew. And I think there's really two reasons why you're seeing this outperformance of international. The first is simply mean reversion. The fourth quarter, you saw an extraordinary outperformance of the S&P versus the EFA in U.S. dollar terms. Much of that was currency driven, but the S&P outperformed by 18 percentage points. Okay. We've unwound about half of that so far, with the EFA up about 8, as you said, and the S&P down about 1.5. So that explains part of it. But I think that there are also three catalysts that are also helping drive this sort of shift in sentiment towards U.S. markets that could be sustainable. First, in Japan, we talked before about corporate reform and the improvement of sort of treatment of shareholders and improved shareholder returns, increase in buybacks and dividends. On a relatively lackluster revenue growth, you saw Q4 profits in Japan go up 12%. So you are seeing margin expansion as some of these corporate reform efforts are actually seeing results in their margins. That's one help. The other is for Japan. The other is for China. Xi Jinping has now sort of woken up to the fact that he really needs the private sector. And if you saw in his commentary, he said he switched his verbiage from common prosperity to get rich first and then common prosperity. That speaks volumes to how much he realizes he's dependent on promoting the private sector and letting the private sector prosper, especially in the tech sector where it's very, very fast moving and competitive. If you look at some of the companies that have, despite the rally you've already seen, some of those companies, especially in the tech sector, continue to trade at significant discounts to their US counterparts, despite the improved outlook there. The third and the biggest catalyst is actually what you're talking about, which is in Europe, you've had a seismic tectonic shift in the outlook for fiscal spending all within the last week or two. And it's still coming together. But what you do know so far is that with the new German government that's been elected, a significant 15% of GDP being spent over the next 5 to 10 years on both defense and infrastructure for improved productivity. That's huge. Second thing is, in Europe, writ large, you have the European Defense Fund being proposed by the central government, which would be another 800 billion euros. And then on top of that, you have the prospect for a durable ceasefire in Ukraine. And that could be another trillion worth of rebuilding, sort of 7 or 8% of GDP. Each of those materially changes the growth trajectory for Europe, for both Europe, the economy, but also for European earnings. And I think that the market is still coming to grips with kind of what the magnitude really looks like. I don't think the market really has fully understood, but they're beginning to sort of wake up. And that, to me, is one of the reasons you're starting to see Europe outperform, and you could see it continue to outperform.
Let's chat about the other big geopolitical issue, which is tariffs, whether domestic or retaliatory. What's your view on the possible winners and losers, and what's your outlook in terms of the impact on markets overall?
As we spoke last time, one can think of tariffs in two different buckets. There's the broad tariff threats, which historically have been negotiating tactics, and then there's been reciprocal tariffs targeted at real trade imbalances and unfair trade practices. Recently, it seems, increasingly, the Trump administration is paying more attention to the ideological wing of the party, which has really focused on broad tariffs implemented at the service of trying to really rebuild the U.S. manufacturing base. That's a laudable goal, and it is acknowledged that they need to take some short-term pain to accept the long-term gain that that would create. However, we've spent 60 years integrating our supply chains with our northern and southern neighbors and our allies around the world for maximum efficiency and lowest cost. So trying to upend that at the service of national security and greater manufacturing jobs is simply going to be disruptive, and markets need to be prepared for that. It also could be inflationary. So the main takeaways are twofold. Investors need to get used to two things. One, higher tariffs, both targeted and broad. And two, higher policy uncertainty, which historically has not been multiple enhancing for stocks. For example, recent corporate surveys have shown a pullback in confidence and an increase in inflation expectations, which could be a headwind to investment and hiring. And similarly, consumer surveys have pulled back. over fears of job losses, as well as higher inflation expectations. That could cause a pullback in consumer spending. So the risks to the economy have gone up, just as risks of higher inflation have also gone up from the disruptions in supply chains. I'm not sure that at 22 times earnings, that is something that the US market is priced for. I'm not sure that those potential headwinds are reflected in current expectations. Similarly, though, on the other hand, I'm not sure that international markets at 14 times earnings are reflecting the potential tailwinds that I discussed earlier, which could be pretty sizable and cause a longer-term sentiment shift than just a short-term trade.
Thanks very much for your time, Adrian. We certainly are in a dynamic market environment.